One of the most common questions I get from business owners who operate as an S corporation or partnership goes something like this. How much more can I take in distributions before I hit the next tax bracket? And that's a reasonable question, but it's also the wrong question. Because for pass-through entities, S corporations, partnerships, multi-member LLCs, you're not taxed on what you take out of the business, you're taxed on what the business earns. That distinction changes everything about how you plan. I'm Bill Bourbonnais, and welcome to Three Things Thursday. Today, we're jumping into three things every pass-through owner needs to understand about profit and distributions. Thing number one, profit is taxable. Distributions generally are not. Let's start with these mechanics because this is the foundational distinction that everything else builds on. An S corporation or a partnership is a pass-through entity. The business itself doesn't pay federal income tax. Instead, the profit, the net income after expenses, passes through to the owner's personal tax returns. Each owner receives a Schedule K-1 that reports their share of that income. That K-1 income is taxable. A distribution is something different. A distribution is the cash transfer of those profits from the business account to the owner's personal account. It's moving money from one pocket to another. And generally speaking, distributions are not a taxable event because you already paid tax on that income as profit when it was earned. Here's a clean way to think about it. Your business earns $200,000 of net profit this year. That $200,000 shows up on your K-1. You pay tax on $200,000. And that's whether you transfer $50,000, $150,000, or the full $200,000 to your personal account as a distribution. That is irrelevant to the tax calculation. The tax was on the profit, not on the distribution. One important caveat, distributions can become taxable when they exceed your basis in the business. But that's a separate conversation for a separate episode. The foundational rule holds. Profit is taxable, distributions are not. So your takeaway for this item, the business reports taxable income based on what it earns. You're taxed on your share of that. The distribution is just the cash transfer of money you've already been taxed on. Thing number two, when you take the money out, doesn't change what you owe. This is the one that causes the most painful April conversations. The misconception goes like this. I had a really good year, but I left most of the money in the business to reinvest. So I should know that much in taxes, right? Wrong. Your tax liability is based on the profit in the business generated as reported on your K-1. The timing of your distributions has no effect on that number. The business earned $300,000. Your K-1 shows $300,000. You owe tax on $300,000. Whether you took out $30,000 or $300,000 out has no bearing on what you owe the IRS. The money sitting in the business account didn't escape taxation. It deferred the cash in your personal account, but not the tax obligation. Owners who don't understand this end up with a significant tax bill and insufficient cash to pay it because they left the money in the business thinking it protected them. The flip side is equally useful to understand. Taking additional distributions in December doesn't increase your tax bill for the year. The profit was already the profit. If you need the cash from the business and your basis supports it, the distribution itself isn't a taxable event. The planning implication, if you're going to owe tax on the profit regardless, the distribution conversation is about cash management and basis, not about reducing your tax bill. Those are different conversations. So thing number two in a nutshell, the timing of your distributions doesn't change what you owe. The K-1 is based on profit earned, not cash taken out. Plan for the tax liability regardless of how much you distribute. Thing number three, the profit on your P&L and the profit on your tax return can often be different numbers. Now, this is a distinction that opens the planning conversation. Your financial statements show accounting profit, revenue minus expenses is recorded under your accounting method. Your return starts with that number, but then makes adjustments for items the tax code treats differently. Those two numbers can often be not the same number. Some items increase your taxable income above your accounting profit. Meals, only 50% of those are deductible. So the other 50% gets added back to your taxable profit. Entertainment expenses are not deductible at all. Those all get added back to your taxable profit. Certain penalties and fines are not deductible. Some life insurance premiums are not deductible. These are real business expenses on your books that the tax code doesn't fully recognize. Other items decrease your taxable income below your accounting profit, depending on your accounting method. Section 179 expensing and bonus depreciation can allow you to deduct the full cost of qualifying assets placed in the year placed in service, rather than depreciating them over time. That may create a larger deduction on the tax return than on the P&L, depending on how your accounting method treats depreciable assets. The result, a business showing $300,000 of profit on the books might show $270,000 of taxable income, or might show $330,000 of taxable income, depending on the activity and the planning in place. That gap, the difference between what your accounting reports show and what the IRS sees, is where strategic planning actually lives. If you're estimating your tax bill based on your P&L, you may be working with the wrong number. And the decisions you make around distributions, retirement contributions, and year-end planning all depend on knowing the right one. So thing number 3 in a nutshell, accounting profit and taxable income are not always the same number. The gap between them is not a problem. It's an opportunity if you know where to look. So in summary, you pay tax on what the business earns, not on the distributions that you take home. The timing of your distributions doesn't change that, and the profit the IRS sees may or may not be the same number that's on your financial statements. Understanding all 3 of these distinctions changes how you plan, how you budget for your tax liability, and what questions you should be asking your tax advisor. If distinctions like this are helpful, 3 Things Thursday drops every week. Hit subscribe or follow so you don't miss the next one. And if any of this applies to your situation, that's a conversation worth having. You can find us at bourbonnaistax.com. I'm Bill Bourbonnais. Thanks for joining us. We'll see you all next week. Thanks a lot.